Trade. If you're a trader looking to understand how the market works at a deeper level, this is the perfect place to start. Miller introduces the powerful concept of supply and demand trading, which is essential for anyone who wants to make informed, calculated decisions in the market. Miller explains how supply and demand dynamics drive price movements and how recognizing these imbalances between buyers and sellers can give you an edge. The main goal of this book is to help you identify high-probability trading zones, those critical areas on the chart where market imbalances create great opportunities. So, if you're ready to learn how to spot those key trading zones and understand market movements like never before, make sure to stick around. And if you're new here, don't forget to like, share, and subscribe for more trading tips, strategies, and detailed breakdowns. Let's jump into the exciting world of supply and demand trading. Chapter 1: Traditional Support and Resistance. Let's begin where most traders start their journey, the age-old concepts of support and resistance. Frank Miller opens this chapter by taking us back to the fundamentals. If you've ever looked at a price chart and seen prices bouncing off certain levels, you've witnessed support and resistance in action. These are the horizontal lines we draw to mark where the price tends to stop falling, support, or rising, resistance. But here's the truth Miller lays bare. Most traders stop here. They use these lines almost mechanically, expecting the market to behave like a bouncing ball. But the market, as we know all too well, is anything but mechanical. Miller paints a picture we've all seen. A trader marks support at a previous low. The price reaches that level again, and boom, it breaks right through. Stop loss hits. Frustration builds. The trader questions their strategy. Sound familiar? What Miller does masterfully in this chapter is not dismiss the value of support and resistance, but expose their limitations. He doesn't say they're useless. Far from it. Instead, he shows how relying solely on them can give traders a false sense of confidence. You see, these levels are derived from past price reactions. But here's the emotional twist. Price doesn't move just because it touched a level in the past. It moves because of the invisible forces behind the candles, the supply and demand of the market participants. Think of it this way. Just because you've been to a restaurant twice doesn't mean it will be open the third time. Something might have changed. The same goes for price levels. The strength behind a support or resistance level is only as good as the active participation of buyers and sellers at that level. Miller shares how many traders are caught in a trap. They expect price to reverse at horizontal lines without asking, why should it reverse here? Who's buying? Who's selling? And if you've traded long enough, you know the market loves to play tricks. It often blows past these lines, triggers stop losses, and then reverses. Painful, right? That's where Miller starts nudging us towards something deeper. He doesn't reveal it fully yet, but he hints that the real power lies in understanding where the imbalance between buying and selling is strongest. And those imbalances? They're not always where the traditional support and resistance lines lie. Let's pause and digest that. Support and resistance are popular because they're simple. They're visual. They make us feel in control. But Miller warns that simplicity without depth leads to misinterpretation. He's seen traders lose over and over again because they rely on static levels instead of dynamic forces. He even points out a common mistake: traders drawing too many levels, cluttering their charts, and confusing themselves. In Miller's words, a chart with more lines than logic is a disaster waiting to happen. He encourages discipline, not in just marking lines, but in understanding why a level matters. Now here's a turning point, the idea of zone-based thinking. While support and resistance are fixed lines, the market doesn't operate in lines, it operates in zones. These zones are regions where buyers or sellers took control. Not just one candle, not just one touch, but repeated aggressive action. Miller has successfully planted a seed in the trader's mind, a sense that perhaps what we've been relying on isn't the full picture. That support and resistance are a start, but not the destination. They're the map, but not the territory. And emotionally, this hits home. How many times have we felt betrayed by a level we trusted? How often have we wondered why price ignored our beautiful chart markings? Miller gives a comforting truth here. It's not our fault. It's just that we're looking at the surface, while the real answers lie deeper in understanding the true forces of supply and demand. Chapter 2, Introduction to Supply and Demand. Imagine standing at the edge of a market chart, not as a trader, but as a detective. You're not chasing indicators or following flashing signals. You're hunting something deeper, something raw, something real. Welcome to the world of supply and demand, the invisible hands that truly move the markets. Frank Miller peels back the curtain to show us the real reason why price moves. And it has nothing to do with luck or guesswork. It's all about one core principle, an imbalance between supply and demand. At first glance, it sounds basic, too simple, maybe. But as Miller walks us through this concept, we realize how everything in trading boils down to this single truth. When there are more buyers than sellers, price rises. When sellers outweigh buyers, price falls. That's it. That's the heartbeat of every market move you've ever seen. But here's where Miller goes deeper. He explains that price doesn't move just anywhere. It moves with intention, with energy, with force. And that force, it comes from large institutions, big money, those who truly create imbalances in the market. Retail traders don't move the markets. Banks, funds, and smart money do. And they do it by creating zones where supply exceeds demand or vice versa. So what does this mean for us? It means our job isn't to predict the future, it's to spot where the imbalance is likely to happen again. Miller gives us a practical image to hold on to. Think of the market like a battlefield. On one side are the buyers, on the other, the sellers. They clash at certain price levels, and sometimes one side overwhelms the other. That's where the magic happens. That's where trading opportunities are born. This leads to the first major insight of the chapter. Price zones are more important than price points. Forget those single-line support and resistance levels. What really matters are areas where strong buying or selling has occurred in the past, zones where institutions made their moves. Those zones, Miller tells us, are likely to be revisited. Why? Because large players don't complete their orders in one go. They leave footprints, and we, as smart traders, can follow those footprints. Miller introduces a subtle but powerful shift in mindset. Most retail traders are reactive. They chase price, follow indicators, or wait for confirmation. But supply and demand trading is proactive. It's about anticipating where the imbalance lies. And that's empowering. There's also an emotional reality here. Many traders, Miller notes, get stuck in noise. Too many indicators, too much clutter. They overcomplicate. But this chapter is a breath of fresh air. It brings us back to the roots of economics, the first thing we learn in school. When demand goes up and supply stays the same, price rises. When supply goes up and demand doesn't, price drops. Trading isn't magic. It's a reflection of this basic principle. But here's the deeper layer. Not all zones are created equal. Miller explains that some supply or demand zones are weak. They barely caused a price move. Others are powerful. They pushed price hard and fast. Those are the zones we care about, because if price returns to them, it may bounce again. He also brings in the idea of freshness. A fresh zone is untouched. Price hasn't come back to it yet. That's important because once a zone is tested, the orders that created the imbalance may be gone. A used zone is like an emptied tank. It won't push price with the same force again. Miller makes it clear. This isn't just a concept, it's a framework for trading. It's how you read the chart, not just by watching price, but by understanding what the price is telling you about the power struggle beneath it. By learning to spot true supply and demand zones, you begin to shift from being a follower to becoming a strategist. You stop reacting and start preparing. You're no longer chasing trades. You're waiting in the shadows, ready to strike when the imbalance tips the scale. Chapter 3, Spotting the Golden Zone. In Spotting the Golden Zone, Frank Miller pulls us into the heart of supply and demand trading by revealing the single most powerful concept in his system, the golden zone. So what is the golden zone? Simply put, it's a price area, not a single point, where a strong imbalance between buyers and sellers occurred, causing a swift and meaningful price movement. It's where the market tipped decisively in one direction. And this decisive move wasn't random. It was triggered by large institutional orders that flooded the market. But here's the emotional hook. When price returns to this zone later, those leftover institutional orders often still remain. And that means you get a second chance to trade that imbalance. Miller calls this zone golden, not because it's rare or mythical, but because of its value. It's where you find the highest probability trades, the cleanest setups, the lowest risk, and the greatest reward. It's the sweet spot of professional trading. To truly appreciate the golden zone, Miller urges us to stop thinking like retail traders. He invites us into the mindset of big money. Institutions don't randomly click buy or sell. They position themselves at key levels where they can quietly build or unload positions without disturbing the market too much. But sometimes the imbalance is so intense that it causes a sharp move away from a zone. That's the footprint we want to follow. Let's dive deeper into the characteristics of a golden zone. 1. A sharp move away. Miller emphasizes this over and over. If price drifts slowly from a zone, it's weak. But if price rockets away, leaving a vacuum behind, that's a sign of a strong imbalance. That's your golden zone. 2. Freshness. If the zone hasn't been revisited yet, it's more powerful. The orders that caused the move may still be waiting there, ready to be triggered again. 3. Clear origin. The zone must be easy to identify. You should be able to see exactly where the move started. This precision helps you mark the zone accurately on your chart. 4. Structure before the move. If price consolidates or bases before launching out of the zone, that's an even stronger signal. It suggests smart money was accumulating or distributing quietly before making their move. Now, how do you actually spot a golden zone on your chart? Miller teaches a simple visual technique. Start by identifying a strong move, either bullish or bearish. Then, trace that move back to where it started. The last candles before the explosion? That's your origin. Mark the high and low of that base as your zone. That's it. It's like finding the ignition point of a rocket launch. You're not interested in the trail of smoke. You want to know where the fire started. Miller helps traders feel confident in waiting. In a world that screams, "Trade now," the golden zone strategy teaches patience. You wait for price to return to a meaningful area. You don't chase, you prepare. And when price does return, you're not jumping in blindly. You've already identified the zone. You've already marked it. You're just watching the price action carefully as it enters the zone, looking for confirmation, like a rejection wick, a tight range, or a volume spike. Miller also touches on why most traders fail to see these zones. It's not because they lack tools. It's because they're distracted by noise, indicators, patterns, conflicting advice. The golden zone cuts through the clutter. It gives you clarity. Trading is about probability, not certainty. But if you can consistently find areas where institutional footprints remain and price reacts to those zones with precision, you've tipped the odds in your favor. Golden zone is not just a technique, it's a shift in mindset. You stop trading randomness. You start trading logic. You stop chasing price. You start anticipating opportunity. And that, for many traders, is the moment where everything changes. Chapter 4. How to Draw Supply-Demand Zones, the Art of Precision Mapping. Miller opens the chapter with a clear message. Drawing zones is a skill, and like all skills, it must be practiced with care and consistency. It's not just about marking any area where price moved fast. It's about recognizing true imbalances on the chart and capturing them with surgical precision. So let's dive into his step-by-step method to identify and draw high-quality zones. Step 1. Find the strong move. The first step is to spot a price movement that was fast and clean. According to Miller, the most reliable zones are created when price explodes away from a level, either up or down, without hesitation. This kind of movement reflects a sudden, overwhelming imbalance between buyers and sellers. But not all fast moves qualify. Miller warns against being fooled by volatility spikes or news-based whipsaws. Instead, look for structured, impulsive moves that are backed by order flow, not chaos. Ask yourself, did price shoot up or down in a way that looked decisive and intentional? If yes, you found the foundation of your zone. Step 2. Trace back to the origin. Next, Miller explains the importance of identifying the base of the move. the launch pad, where the supply or demand imbalance began. This is typically a small consolidation area, a pause, or a series of candles that formed before the sharp move happened. This is where the smart money was likely placing their orders. The trick is to find the last candle or group of candles before the breakout. For a supply zone, where selling pressure took over, trace the move back to the last bullish candle before the price dropped. For a demand zone, where buying pressure dominated, go back to the last bearish candle before the price surged upward. That specific candle or group of candles is your zone origin. Mark the zone properly. Now comes the crucial part, drawing the zone with accuracy. For demand zones, mark from the low of the lowest wick in the base to the high of the last bearish candle before the price pushed up. For supply zones, mark from the high of the highest wick in the base to the low of the last bullish candle before the drop. These boundaries form your zone rectangle on the chart. Miller insists that less is more here. Don't make the zone too wide, or you'll dilute your entry accuracy. Don't make it too narrow either, or you risk missing the bounce. Precision is key. He emphasizes the importance of using wicks, not just candle bodies. Why? Because wicks often show where orders were triggered, and price briefly tested those areas before reversing. These are important clues left behind by big players. Step 4. Validate the zone. After drawing the zone, your next task is to validate it. Not every zone is worth trading. Miller suggests checking for a few key factors. Strength of the move away. Did price leave the zone aggressively, without chopping or hesitation? Time spent in the zone. Shorter is better. A zone that held price for just a few candles before an explosive move is more powerful. Has price returned to this zone before? If not, it's considered fresh and more likely to react. Location. Is the zone in alignment with higher time frame trends or major structure? Context matters. This step ensures you're not just drawing boxes, but identifying meaningful levels where institutional orders are likely to reside. Emotional discipline and consistency. Miller doesn't shy away from addressing the psychological side either. Drawing zones requires discipline and consistency. Many traders overdraw or second-guess their zones. But Miller advises to trust your process, stick to the rules, and refine through practice, not emotion. There's also a warning. Don't chase price. If you missed an entry because your zone wasn't perfect, let it go. The market always offers more opportunities. A forced entry just to be in the trade often leads to regret. Chapter 5. Always stick to the best. The discipline of trading only high-quality zones. Frank Miller issues a firm but friendly challenge to all traders. Stop settling for average zones. If you want consistent success in supply and demand trading, you must learn to stick only to the best quality zones, no matter how tempting it is to chase lesser setups. This isn't just a rule, it's a mindset. Miller starts by addressing a common trap, the fear of missing out. Many traders, especially those just starting out, feel a constant urge to be in the market. They mark weak zones just to have something to trade. But here's the truth Miller hammers in. Low-quality zones lead to low-quality results. And in trading, those results cost you money. Instead of trading every minor imbalance, Miller urges us to develop the skill and the discipline to say no, to wait, to let the market come to you with a zone that checks all the right boxes. So what actually makes a zone the best? Miller gives us a set of clear, actionable criteria to evaluate the strength and reliability of a supply or demand zone. 1. Strength of the move away. The faster and more powerful the move away from the zone, the better. If price launches out of a zone with large candles and little to no overlap, it signals a violent imbalance. That's what you want. Miller calls this the zone's footprint. A strong footprint shows that big players stepped in. A weak one, small candles, wicks, hesitation, suggests indecision. Avoid those. Ask yourself, did price leave the zone like it was shot out of a cannon? If yes, this is a candidate for a high-quality zone. 2. Time spent in the zone. Here's an interesting insight. The best zones form quickly. Price doesn't linger when institutions are active. Big money moves in stealth. They build positions fast and then let price fly. So if price spent just a few candles forming the zone before exploding out, that's a strong sign. But if price hung around, consolidated for too long, or showed lots of wicks, that zone may be contaminated or less reliable. Shorter time, stronger intent. 3. Freshness of the zone. Miller emphasizes trading fresh zones only. Once a zone has been touched or tested, the institutional orders sitting there may already be filled. That reduces the chance of another strong reaction. Fresh zones, those that haven't been visited since the initial move, have the highest probability of working. They're untouched battlegrounds, with unfilled orders still waiting. Bottom line, if the zone has already reacted, it's no longer the best. 4. Location and context. This is where experience kicks in. A strong zone isn't just strong on its own, it must also make sense within the bigger picture. Is the zone aligned with the higher time frame trend? Is it near a key turning point in the market structure? Does it sit above or below a recent range, suggesting a breakout trap? Miller urges traders to zoom out before trusting any zone. The best setups align across multiple timeframes. A demand zone on the 15-minute chart means little if the 4-hour trend is crashing downward. Context matters. 5. Clear structure and clean candles. Clarity is everything. The best zones are easy to spot. They don't require overthinking. A good zone should have a tight base, the consolidation before the move, clean candles without excessive wicks, a smooth departure from the base, no chop. If you have to convince yourself it's a good zone, it probably isn't. Why most traders settle for less. Miller gets real about the emotional side of this. Most traders don't stick to the best zones because they're impatient. They feel pressure to always be in a trade, but this mindset leads to poor decisions. He compares it to choosing between fast food and a gourmet meal. The fast food is quick and easy, but often regretful. The gourmet dish takes time, care, and preparation, but it's worth the wait. Trading is the same. How to build the discipline. Miller offers practical tips to stay disciplined. Create a checklist based on the 5 criteria. Don't trade a zone unless it ticks at least 4. Journal your trades. Track which zones worked and which didn't. Patterns will emerge. Trust the data, not your emotions. When you stick to only high-quality zones, your win rate improves, even if you take fewer trades. And here's the powerful mindset shift. Quality beats quantity. One A-plus trade is worth more than 5 mediocre ones. Patience isn't passive, it's strategic. Chapter 6, Tradable or Not, the Power of a Scoring System. Imagine this. You're staring at your screen. A supply zone looks decent. Not great, not terrible. Your gut says maybe. But your mind? It's torn. Should you take the trade or pass? The problem: emotions in trade selection. Miller starts with the hard truth. Most traders rely too heavily on feeling. They see a zone, hesitate, then take the trade anyway, only to regret it when it doesn't work. The root cause? No filter, no system, no scoring. So instead of asking, do I feel like this zone looks good? Miller wants you to ask, how does this zone score on the checklist? This flips your mindset from emotional to mechanical, from reactive to strategic. The scoring system, 0 to 10 points of precision. Miller introduces a 10-point scoring system that evaluates supply and demand zones across multiple dimensions. The goal is clear: only trade zones that score 7 or above. Let's walk through each scoring factor. 1. Strength of the move away, 2 points. This is non-negotiable. If price launched out of the zone with strong, large-bodied candles, little to no overlap, and minimal wicks, give it 2 points. If the move was decent but not explosive, give it 1. If price crawled away from the zone, give it it's not tradable. Tot 2. Time spent in the zone, 2 points. The best zones form quickly, usually within 6 candles. That suggests strong intent from institutions. Short time spent equals 2 points. Moderate equals 1 point. Lingering base equals 0. 3. Freshness, 1 point. If price has never returned to the zone since its formation, give it a 1. If it has already been tested or broken, 0. Fresh zones have unfilled orders. That's where the edge lies. 4. Clarity of the zone, 1 point. Is the base clean and easy to identify? Are the candles tight and readable? A visually clear zone gets 1 point. If it's messy, skip it. Remember, if you struggle to market, it's probably not worth trading. 5. Engulfing pattern before departure, 1 point. Did an engulfing candle, bullish or bearish, kick off the move from the zone? That's often a sign of large institutional interest. If yes, give it 1 point. 6. Location relative to structure, 2 points. This one's critical. If the zone is aligned with a higher time frame trend or forms near key support resistance, trend line, or Fibonacci level, give it 2 points. If it's neutral or questionable, 1 point. Against trend, 0. A great zone in the wrong place is a trap. Mot 7. Size of the zone, 1 point. Tight zones are more efficient and precise. If the zone is narrow and clean, ideal for stop-loss placement, give it 1 point. If it's wide and sloppy, it's less practical, 0 points. This scoring system becomes your personal trade filter, a psychological anchor that keeps you disciplined, no matter how exciting a setup looks. The psychological edge. Now, let's talk about the hidden benefit of this system. By assigning a score, you're removing emotion from the equation. There's no second guessing, no impulsive clicking. You're following a repeatable process, and that creates confidence. Over time, Miller notes, traders who use this system stop chasing trades. They start hunting for quality. They take fewer setups, but with higher conviction and better results. You stop being a gambler. You become a strategist. Journaling the scores. Miller suggests a powerful habit. Record the scores of every zone you trade in your journal. Note the outcome. Did a 9-point zone work? Did a 6-point zone fail? Patterns will begin to emerge. You'll see what combinations deliver results and where you tend to make exceptions. This feedback loop makes you sharper with every trade. And eventually, your eye becomes so trained that you can spot a high-scoring zone almost instantly. Chapter 7, The Price Actions Messages, Learning to Listen to the Market. Frank Miller opens with a compelling idea. The market is always speaking. The question is, are you listening? Trading isn't just about spotting supply and demand zones. It's about understanding what the market is trying to tell you through price action, especially within and around these zones. This chapter teaches traders how to interpret those subtle but powerful messages. Miller reminds us, charts are not just patterns. They are reflections of human behavior, emotions, and institutional intent. Every candle printed on the chart has a story behind it. Learning to read those stories helps you anticipate price behavior with greater precision. Why price action matters so much. Think of supply and demand zones as potential battlefields. But how do you know who's winning, the buyers or the sellers? That's where price action steps in. Miller emphasizes that the behavior of price as it enters, interacts with, and exits a zone reveals everything you need to know about market sentiment. Instead of reacting late, you start anticipating. You're not guessing, you're reading the signs. Approach behavior, how price arrives at the zone. The first message comes before price even touches the zone. If price approaches a demand zone with small candles, wicks on the bottom, and low volume, it shows hesitation from sellers. Buyers may be preparing to step in. That's a good sign. But if price races into the zone with strong bearish candles and high momentum, it could break through the zone instead of bouncing off it. The message? The strength of the approach affects the strength of the reaction. Fast approach equals weaker bounce. Slow, respectful approach equals higher bounce potential. Mot 2. Reaction at the zone. The battle unfolds. Now, price touches the zone. What happens? Miller explains that the initial reaction tells you if institutions are defending that zone. A sharp bounce with large bullish candles from demand or bearish from supply signals strong orders and high conviction. A hesitant, choppy reaction with indecision candles, dojis, spinning tops, may mean the zone is being tested or even absorbed. Here, he introduces a subtle concept, absorption versus rejection. If the market is absorbing orders slowly, price may stall at the zone before breaking it. If there's a clear rejection, you'll see an aggressive reversal. Reading these candles gives you a front-row seat to the battle of buyers versus sellers. 3. Candle clues, the language of price. Frank Miller encourages traders to focus on a few critical candle types near zones. Engulfing candles. a strong signal of momentum shift, especially if it happens right at the edge of the zone. Pin bars, hammer candles, sign of rejection. When wicks show price was pushed away from the zone, institutions may be active. Inside bars, pause or build up. When you see multiple inside bars near a zone, get ready. It could explode soon. He reminds us, context is everything. A pin bar on its own isn't a holy grail, but a pin bar that forms after a slow approach and right at the edge of a high-quality zone, that's a conversation worth listening to. 4. Exit behavior. The follow-through tells the truth. After the zone reacts, what does price do next? Miller says follow-through confirms intent. If price reacts strongly from a demand zone and then breaks above recent highs with ease, that zone was legit. Institutions were likely involved, but if price reacts and then reverses back down quickly, it may have been a trap or a weak zone. Your job? Observe and adapt. Let price action confirm or cancel your bias. 5. Volume as a supporting actor. Though not the focus of Miller's method, volume spikes near zones often confirm hidden institutional activity. When a zone reacts and volume spikes, someone big is stepping in. But volume without price action context is noise. Use it only as supporting evidence, not a primary signal. Reading fakeouts and traps. One of the market's cruelest tricks is the fake breakout, where price briefly moves past a zone, triggering stop losses, and then reverses hard. Miller urges traders to be cautious. Watch for wicked candles that pierce a zone but fail to close beyond it. These are often signs of liquidity hunts. Recognizing these traps gives you an edge over those who panic. Miller closes this chapter with a gentle reminder. You don't need to predict the market. You just need to observe and react intelligently. Chapter 8. Flip zones. In trading, there are moments where the market shifts gears. What was once a strong resistance suddenly becomes support, or a demand zone that held firm yesterday now acts as resistance today. These pivotal areas are what Frank Miller calls flip zones. Imagine price rallies into a supply zone and gets rejected, classic scenario. But then, instead of turning back lower, price breaks through that zone and keeps climbing. Now that supply zone has lost its selling power, but that doesn't mean it's irrelevant. Quite the opposite. Once price pulls back to that same level, it often acts as demand, creating a flip. Same level, different behavior. That's the power of a flip zone. According to Miller, these zones represent a shift in control. Where sellers once dominated, buyers have now taken charge. And this shift is not random. It's often triggered by institutional orders getting absorbed, replaced, or reversed. Why flip zones are so powerful? Flip zones are one of the market's clearest confirmations of sentiment change. They offer two major advantages for traders. One, they confirm trend direction. When a former supply turns into demand, it reinforces that bulls are now in control. The trend is strong. Two, they offer high probability entries. Because these zones have a proven track record, they were respected once, then broken. They act as magnet levels where price often retests and continues. In other words, flip zones are both confirmation and opportunity. How to identify a flip zone? Miller breaks this down into a simple visual process. 1. Spot a clean supply or demand zone. Start with a well-defined supply or demand zone, something with a strong move away, few candles, and no prior tests. 2. Wait for price to break through that zone. If price cuts through with large candles, minimal resistance, and strong follow-through, it's likely that the original orders were overwhelmed. 3. Watch for the pullback. Now price starts to retrace. Watch closely as it returns to the broken zone. If the market holds there, opposite to the previous behavior, you've got a flip. Number 4, look for confirmation signals. Here's where price action matters. A bounce off the flip zone, rejection candles, or engulfing patterns confirm the shift in sentiment. This entire sequence shows that the market has changed its mind, and it's inviting you to follow its lead. Let's say price approaches a supply zone at 125.50 and sharply reverses. Great. But then later, price climbs back up and breaks right through that level. Now, 125 is no longer a barrier. It's a potential new floor. When price returns to 125.50 and you see a bullish engulfing candle or pin bar, that's your entry signal. You're not trading against the trend. You're trading with the new flow of power, flip zones in ranging markets. Miller also explains that flip zones are particularly useful in sideways or choppy markets, where support and resistance keep switching roles. In these environments, being able to spot the flip before others gives you a huge edge. Instead of getting chopped up, you're trading with structure. Common mistakes to avoid. While flip zones are powerful, they require caution. Miller warns against trading before the flip is confirmed. Just because price breaks through a zone doesn't mean it's a true flip. Wait for the retest. Forcing flips in weak zones. Only use well-formed zones with strong structure. A sloppy zone won't flip cleanly. It might just fake you out. Ignoring trend context. A flip zone that aligns with the overall trend is much more reliable than one that doesn't. How to trade flip zones safely. Miller gives this practical approach. Entry. Wait for a clear rejection at the flip zone. Pin bar, engulfing, or sharp bounce. Stop loss. Just below for demand flips or above for supply flips the zone. Target. Use the next zone in the direction of the move or a recent swing high-low. This setup lets you trade with confidence. You're entering where the market has already shown its cards. Miller concludes by reminding us, flip zones are not just technical levels. They're a reflection of the market's memory. They show where buyers and sellers have clashed before and where the balance of power has shifted. Chapter 9, Reversal and Continuation Trading with Supply-Demand. Frank Miller takes a deep dive into the two core types of market movements that traders face, reversals and continuations. Both represent different sides of the market's psychology, and Miller explains how to approach these movements with supply and demand analysis. Before diving into trading strategies, Miller defines reversals and continuations in the context of supply and demand. Reversals, a shift in market direction. For example, when price reaches a supply or demand zone, and instead of continuing the previous trend, it turns around. This is a reversal. Continuations, when price hits a zone and continues in the same direction, either moving further up in an uptrend or down in a downtrend. In these cases, the zone doesn't stop the trend, but extends it. Miller stresses that recognizing the right type of market movement is crucial. Not all supply and demand zones are meant to reverse trends, and not all will lead to trend continuations. Your job as a trader is to identify which one it is. Reversal trading with supply-demand zones. When it comes to reversals, Miller introduces a key principle. Strong supply and demand zones are often reversal points. 1. Spotting reversals. Reversals typically happen when price enters a well-formed supply or demand zone with high momentum and breaks out sharply from it. These zones are often untested and come after a strong market move. Example, if the market has been in an uptrend and you see a sharp drop into a demand zone and then price shows a solid bullish engulfing candle, this is your sign for a potential reversal to the upside. 2. Price action signals. Miller emphasizes that price action is key. Look for strong, clear signals within the zone like pin bars, engulfing candles, or hammer candles. These signals tell you that the buyers or sellers have taken control and the trend is likely to reverse. 3. Why these zones work for reversals. Reversal setups often occur in zones where price has either previously reversed strongly or where institutional activity is likely to initiate fresh buying or selling pressure. 4. Stop loss and targets for reversal trades. When trading reversals, Miller suggests placing your stop loss just below for demand or above for supply, the zone. Your targets should ideally be the next supply for a demand reversal or demand for a supply reversal zone. This gives you a high reward setup with low risk, provided the reversal is supported by solid price action. Continuation trading with supply-demand zones. On the flip side, continuation trading involves trading with the prevailing trend, riding the momentum rather than betting on a reversal. Miller explains that continuation trades are often higher probability since they align with the broader market direction. 1. Spotting continuations. A continuation trade happens when price hits a demand zone in an uptrend or a supply zone in a downtrend and continues in the direction of the trend. Example, imagine the market is in an uptrend. price pulls back into a well-formed demand zone without breaking it. If price respects the zone and continues upwards, this confirms the continuation of the uptrend. 2. The power of momentum. Miller stresses that continuations work best in trending markets. Strong trends have a higher chance of continuing once they hit a well-established zone of supply or demand. This is because the imbalance between buyers and sellers remains, and the trend is likely to persist as long as the zone holds. 3. How to trade continuations. Just like reversal trades, continuation setups require confirmation from price action signals. Look for sharp moves out of the zone or small consolidation patterns followed by big moves. Breakouts from consolidation areas or clear momentum candles signal the trend will continue. 4. Stop loss and targets for continuation trades. For continuation trades, place your stop loss just below the demand zone for buying or above the supply zone for selling. As for targets, aim for the next key resistance or support levels. You're aiming to ride the wave further along the trend. Miller also highlights the key differences between these two types of setups. 1. Reversal setups typically involve zones that have been untested or overextended, where price has broken the structure and is showing signs of a new direction. 2. Continuation setups are based on strong trends, where price simply retests the zone and continues without breaking previous structure. Chapter 10. Gap Trading with Supply and Demand. Frank Miller dives into the intriguing world of gap trading, one of the most exciting yet challenging aspects of trading. Gaps often create significant opportunities in the market, but Miller emphasizes that understanding how they relate to supply and demand zones is the key to trading them effectively. Gaps represent price dislocations, moments where price jumps over a level without any trading in between. These occurrences often come with substantial momentum and can be incredibly profitable if you know how to read and trade them. Miller shows us how to use supply and demand analysis to identify, interpret, and take advantage of these gaps. What are price gaps? First, Miller defines a gap as a situation where the opening price of a new trading period, like the next day or the next session, is significantly different from the previous closing price. This creates a gap in the price chart, which can signal a potential change in market sentiment. There are several types of gaps, but for the purpose of this chapter, Miller focuses on the two that are most relevant to supply and demand traders. 1. Breakaway gaps. These occur when price breaks out of a range or consolidating area and leaves a gap behind. The gap indicates a shift in market dynamics, either a breakout from a supply zone or demand zone. 2. Gaps. These happen near the end of a trend and often signal a potential reversal. These gaps occur when the market exhausts its current momentum and may quickly reverse. They often appear in an overextended market. Miller emphasizes that the key to trading gaps effectively lies in understanding their context, where they form in relation to supply and demand zones. Gaps in unimportant areas may be just noise, but gaps that occur at or near strong supply or demand zones can create incredible trading opportunities. How gaps relate to supply and demand zones. According to Miller, gaps can be thought of as a sign of a supply-demand imbalance. When a gap occurs, it often means that there was a surge in buying or selling pressure that couldn't be absorbed in the usual trading range. This creates a sharp move, sometimes far beyond previous levels. 1. Gaps at demand zones. When price gaps up into a demand zone, it suggests that there is unfilled demand beneath the market. In this case, the gap can act as a magnet for price, pulling it back to test the demand zone before the next move. Traders can look for bullish reversal signals at the demand zone to enter long positions. 2. Gaps at supply zones. Similarly, when price gaps down into a supply zone, it indicates unfilled supply above the market. This can cause a sharp reversal as the selling pressure is absorbed. If price returns to the gap area, it's often met with strong resistance from the supply zone, giving traders a chance to enter short trades. Miller stresses that these zones are critical for identifying where the gap will likely resolve. If the gap occurs far from any significant supply or demand zone, it may be best to avoid trading it, since the gap may be just noise. But when gaps occur at key price levels, they offer huge potential for identifying high-probability setups. Now that we understand the relationship between gaps and supply and demand zones, Miller shares his strategy for trading these gaps. 1. Identify the type of gap. Miller suggests identifying whether the gap is a breakaway gap or an exhaustion gap. Each type requires a different approach. Breakaway gaps. These are strong, one-way moves that signal the start of a new trend. These are usually traded in the direction of the gap. Exhaustion gaps. These occur at the end of a trend and often signal a reversal. These are best traded against the gap, anticipating a reversal at the supply or demand zone. 2. Wait for price action confirmation. Don't jump into a trade immediately after the gap. Miller advises waiting for confirmation, either a price action signal, like a pin bar, engulfing candle, or hammer at the supply-demand zone, or a pullback that tests the gap area. This confirmation will help you avoid false breakouts or gap fills that don't lead anywhere. Number 3, target the gap's fulfillment. A key rule Miller gives is that gaps often get filled. If the gap creates a significant imbalance in supply and demand, the price will likely return to the gap area at some point. Traders can target the gap fill as their initial profit target, with additional targets based on the next supply or demand zone. Let's consider a breakaway gap that occurs in an uptrend. Price gaps up into a strong demand zone, showing that buyers are in control and willing to pay higher prices. Miller suggests looking for bullish price action, like an engulfing bar, when price retraces back into the gap area. Once confirmed, this is your opportunity to enter long with a target at the next resistance level, likely in the form of an untested supply zone. In contrast, with an exhaustion gap in a downtrend, price gaps down into a strong supply zone. Miller suggests waiting for signs of reversal when price tests the gap area. Look for bearish price action signals, such as a pin bar or engulfing candle, which can confirm the beginning of a reversal. You'd enter short with a target at the nearest demand zone, where the price might find support. The risks of gap trading. Miller also highlights some risks associated with gap trading. Gaps can lead to false breakouts or get filled quickly, especially if the gap is not based on solid supply-demand dynamics. It's essential to wait for price action confirmation before entering a trade to avoid being caught in a false move. Also, gaps that occur in choppy or sideways markets tend to be less reliable. Gaps in strong trends, however, are usually high-probability trades and offer better setups. Chapter 11, CCI Techniques, Enhancing Your Strategy with the Commodity Channel Index. Frank Miller introduces the Commodity Channel Index, CCI, as a powerful tool that can complement supply and demand analysis. He explains how this momentum oscillator helps traders gain a clearer view of market conditions, pinpointing overbought or oversold conditions, and improving the precision of entry and exit points. What is the Commodity Channel Index, CCI? The CCI is a momentum-based indicator designed to measure the deviation of price from its average price over a specified period. Essentially, it calculates how far the price has moved from the average over a set time frame, with values typically ranging from -100 to +100s. Above 100, the market is considered overbought, suggesting that the price has risen significantly above the average, and a potential reversal or pullback might be on the horizon. Below -100, the market is oversold, implying that the price has dropped below its average and may reverse or experience a bounce. Miller highlights that the CCI, by focusing on price deviations, gives a more dynamic understanding of market momentum. Unlike other indicators that lag behind price movements, the CCI aims to anticipate price movements, making it a valuable addition to a trader's toolkit. Why combine CCI with supply and demand? Miller stresses that while supply and demand analysis shows us the zones where price is likely to reverse or continue, the CCI provides additional confirmation on whether the price is overextended within these zones. Here's how the two can complement each other. 1. CCI for momentum. The CCI reveals whether a market is in a strong trend or showing signs of overextension. When combined with supply and demand analysis, it can give you a clear idea of whether a price is ready to reverse at a demand zone when the CCI is oversold or a supply zone when the CCI is overbought. 2. Early signal for reversals. While supply and demand zones tell us where reversals are likely, the CCI helps us pinpoint when those reversals are likely to occur. A CCI...
Good morning, good afternoon, good evening. Wherever you're trading from, make sure you make it a good, healthy trade. All right, so I already got all the overviews out the way. Top steps to shit. Get that out the way. Apex is really good too. Getting ready to go ahead and place my first trade of the day. Past the 8:45 time frame. I gave it a little bit more, to make sure. That looks like the trend. I took a nap at 5 o'clock. Came back around 6:30. It's like, oh, okay. I'll do some yoga now. Got on the phone with Top Step around here, and just continue to go upside. So I'm get in here, worry about this next trade. It's definitely holding that nice round number at 1900. So I like to see it keep on pushing. You know what I mean? Definitely bull flag trying to sit up there. Might get into some type of chop range, or we might keep on pushing here. On a 5 minute, I know we're gonna come back and see some of this money. I'll be looking to buy the dip. Where it's looking. I haven't paid attention to any news, so I'm gonna go lock in on that. Maybe turn on Top Step now. That's not a bad idea. Boom. So boom, we're in there. This is what I do and how I do it. The biggest contradiction is, ain't none of your business. Good morning, y'all. Let's close out this week's show.
Track more shorter time frame market order sellers. That's when we end up getting those late squeezes in either direction. So we started to see some light iceberg buy orders in gold at 33.25, and we're getting a little bit of a pop off of that. I don't know if the downside is done yet, but at least there's the hint of possibly some longer time frame buyers. We have negative delta still, so yeah, that's the iceberg order. If they have a big package, they piece the orders in a little bit at a time, a little bit at a time, a little bit at a time. And sometimes you'll have an entity that'll have an all-day order where they're just going to be buying all day, and they keep putting in iceberg, and end up getting the short time frame shorts or long in the opposite direction if they're sellers. So it's just a way for an entity that has a lot of contracts to trade that day to hide their activities.
Is that what you used to do, Hogue, on the floor?
Yes.
What's the biggest order size you got to Bill?
For a whole day, about 10 to 15,000 contracts in the big S&Ps.
Oh, Jesus.
How about those commissions, Hogue?
How
about those commissions, my man? We had steak that night, man. Hell.
We used to do that too, Hogue, because when you're spreading, you don't want to be hit or lifted on too much at once to get hedged. So you would just feed it in at some pre-designed clip that you decided what it was, and then reload.
That's why that's where people would need to be your friends to get a little bit of information.
This is one of my rating.
Okay.
Pushing higher here. All right, real quick. Pop quiz time. Pop quiz. We're going to make sure we hook you up with a little something. It's not asking you what the tip of the week is. That is not the pop quiz today. I'm going to ask Eddie. Hey, Eddie, the pop quiz is who was on top quiz yesterday with Eddie? First one to answer. All eyes in the chat. First one to answer. Reach out to you and hook you up with a little something. Dakota, you are not eligible to play.
Silencio, por favor.
Was I right though?
No,
I didn't watch it.
You're not. You're not. There it is. Cena. Got it.
Man
Well
down.
done. Quick to the draw.
Good job.
That's what you guys get for listening to me.
That's what you get for not paying and watching, Dakota. You were even watch. You were on. Weren't you on the segment right before that too? Weren't you on?
Well, yeah, but I have an hour lunch, so I was getting food.
Oh no, Jose. It wasn't Bonnie. No. Bonnie
1
was on
minute.
Monday.
1 minute. We'll get the tip of the week after this. We will get that to you. We got 1 minute till the numbers shouldn't be that wild. Although it wasn't. New home sales came in much better than expected. Month over month.
44 seconds. Well, what they're
44
saying is 4.13. They're looking at 4.13 existing home sales, prior 4.26. And the sales change, this might skew a bit here. We had a previous of a positive 4.2. They're looking at negative 3.05%. So might see something there. 20 seconds on these numbers.
This market needs to go higher. It wouldn't be a normal day if we don't go up or down 2%.
54.40. Last trade ES 19,050. We are in Barron Supply Zone. We got the number here in about 5 seconds to see what happens. Eddie, all you, my man.
Okay, coming in here, existing home sales 4.02. They were looking at 4.13, coming in at 4.02. The negative 3.5, even deeper, negative 5. And existing home sales change. There you have it. Back to you.
All right, good stuff. Hey, Barron. All right, we're up in your supply zone. Buyers look strong. Keep moving up and to the right here. Anywhere from 040 up to 19,200. Last trade 19,060. 060. What are you looking for in this area?
We just grind through. Either we grind through this or we start to get a retrace. I don't want to short it though. I just want to find a retrace and get long.
Okay.
I just don't want to get long. Like, it's kind of sketchy to get long up here, you know?
Here you go. How deep of a pullback would you look for? You know, the same thing.
I would look for either go back to the 0.5 or 0.618 fib, and then see if that lines up with an area where we had big buyers on book map. So let me check real quick.
Still pushing higher here.
We've had strong buying all the way from 19,018 all the way up this entire rally. About the same size volume for each of these buyers. So nothing really standing out to me as a big active buyer. But if we do start to get a retrace, we see a lot of selling pressure and market doesn't continue to move lower, that's the entry.
Thank you. Jack?
I'm okay with shorting this. If we could get up to those 130s and show some type of 3-bar reversal or rejection of those highs.
Yeah, I'm kind of with Dakota on that one.
Short.
It's just
Darth Vader.
This isn't a no trade zone though, because it's so strong. You don't want to sell it now until we get to that level.
Yeah.
So then you don't want to buy it because it's overextended the right word? I don't know.
It's
at this point.
To me, this is like, it could just grind all the way through this.
Yeah.
It's kind of what's in my head. It's tough to short unless you see strong displacement, and then you get a nice retest. I'd prefer to either just wait for the strong displacement to the downside, see a retest, enter on the retest, or just wait for it to retrace, get in at the fib for long.
Yeah. Look at this 5-minute chart. All
It's green.
candle
Yeah.
starting
Yeah.
from 8-10. How many in a row?
Oh hell! 1, 2, 3, 4, 5, 6,
11?
7, 8, 9 ish. Well, what time is it?
Yeah.
It's about 6 of them at least.
Yeah.
Right?
3, 4, 5, 6, 7, 8, 9, 10. This is the 11th candle on the 5-minute chart of just green, just pushing.
We are getting big selling at these highs.
Yeah, I took a heat
so we'll
check,
see if it
short
goes
5
lower.
MES, 38.
This is the first sign of selling that we've had since like 8:50 Central. So first sign of selling in the last 10 minutes.
Yeah, Jack, you're
That
short.
is-
I like that trade.
It doesn't always indicate that they'll get rewarded for the plane.
Or it's low probability.
Where's your stop?
Right now, I just threw one in there a little bit beyond the highs of the day, but I think I might move it down below that to tighten this up.
I'm looking for the way that this market could run stops before going lower, because there's going to be a lot of people trying, myself included. What's the tip of the week?
Oh, funny you ask. Funny you ask. What is the tip of the week? Eddie, take it away.
Yes.
What is the tip of the week?
Tip of the week is leverage the power of trends. Yes, indeed, ladies and gentlemen. Leverage that power because you know what? It does help. Institutional behavior. I'm going to tell you about this one. Now, institutions often drive and ride trends, and following them puts you on the same side of the trade. So keep an eye on that. Also, risk management is easier with clear trend structure. Traders can see markets, smarter stops and targets. Also, reduces over trading. Now, waiting for trend confirmation also helps avoid impulsive high frequency losses. And the last one I've got here for you, history repeats itself. Yes, we know that. Trends tend to persist due to the recurring market psychology, making them a powerful edge when recognizing earlier. So leverage the power of trends. Thank you, Andre.
Ah,
Yeah, I did not on Tuesday, and that smacked me. It gave me. You guys see it, and but there is something to be said to selling these extremes. I want to see if we could run stop on where the most pain is. I mean, I don't know if we're going to run all the way up to 170 of people who were short yesterday from this pivot. If we run
Eddie,
above that
hit
and
it.
then revert.
Eddie hit it.
Those sellers
We got it here.
rewarded.
We got Waller coming in here.
Hey, Rock.
Talking about it's not likely that by July.
What'd you say? I'm sorry.
Tariff impact yet. Waller kicking in here just out of nowhere once again.
Where the hell is this?
Wouldn't surprise
took
me to
this
see
breakout
more
right
layoffs
here.
and higher unemployment. It also says
At
smaller tariffs will
9:49,
have the
it was
modest
after the 15
pass-through,
minutes, and then that
meaning
it had
better
that
control
rejection
on the
candle
budget
right there,
deficit. So these are some of the comments.
and I rolled it
off
up.
the wire here right now.
Not on the
Yeah,
schedule.
wait.
I
wait,
seen
Let
that.
those can go for a second. We just lost 150.
I checked the charts this morning. I always
Trump's
check,
in
man.
Norway,
Yes.
right?
Trump's in Norway.
He's
What's he doing there?
Schedule.
Maybe learning how to play chess.
With Carlson, what's his name?
Magnus,
Magnus?
yeah, man, the goat.
Yes, he is. Refuses to wear slacks in chess matches. Wants to wear the blue
Made an
denims.
amazing record, dude. He went 9-0 at a chess tournament this past week.
That's pretty good. That's really damn good.
Dakota, you were
Yeah,
saying you got
so-
smacked by a friend on Tuesday?
Yeah, it was
Calling it.
Tuesday. I was shorting. It was this gap. I was
Oh,
shorting
okay.
this.
You said you didn't catch it though.
Yeah.
And it just went straight up. And then I tried another short, and it,
Yeah, I said I was gonna start playing around with
when
London
you
because
see, Whenever you see London,
Chanel is in since she's in Thailand. I know London it would be a better time for her to get
I
on
rode
too
that
sometime.
Not all day. I wanted to ride it all day, but I called my friend. He was like, "You're up so much, you need to close the positions and go for a walk." And I was like, "That's valid." So,
that's a good friend.
Yeah, it's supposed to be a lot smoother. I never
Screenshot.
trade. I traded it when I used to do Forex, but I haven't traded it since futures. Oh, sweet. Okay.
So when this is set up like this, right? If you ever trade those a lot of meme coins, pull up one of those scams, but it's not a scam, you know, it's not a scam. Yeah, look at it. It got some history behind this one. Just continue to run. So this might be well, I'm not going to be the first one to jump in front of a dip buy here. They can reverse 2, 3 candles, or even more. It was this little first stop there. Whoever got there was lucky. They just calculated it very well. Got in, got out. I was too busy here talking too smooth. Alright, I'm locking in. I'm gonna lock out. Getting steak regardless tonight. Maybe some bulgogi. Either way. Getting it double. With potatoes. Stay healthy. Stay hungry. Make sure you mind your own business. Because this is none of yours. It looked like a nice little bounce. It's not confirmed yet. They're still in this range here. They can come all the way down and fall all the way through in the 5-minute, 15-minute range. You see. So what I'm not gonna do is, wow, look at the wrong chart again. Too many things going on. You trade one at a time. But yeah, that definitely was the bounce still. That's why I missed that move. Not necessarily. Wow. Well, no position is better than any position at all. Let's lose money. I was way out here with it. Forgot that I did this today. Just moving and grooving. That's why I anticipated not to place a trade because I've done that before. You're trying to grab great content, reach out to some of the traders that's really out here doing this, and really out here dedicated making content while trading. You gotta be something different to be able to do that and still be doing this, This is actually my first time stepping off into the streaming realm, I must say. So running the OBS and all that, it's been a long time coming, I tell you that much. There's a backstory to that. Hopefully one day we'll be able to tell it. This is my journal. This is what I do. And how I'll be doing it a little bit better each and every day. If you want to learn more, you want to do more. If you just sick of strolling on Facebook, Instagram, and you just randomly came across this video, or a link to this video, go ahead and join the Discord, find out what we're about. Alright, catch up with y'all. Start looking for an entry, and it definitely looks like an old school meme coins. Take it straight from here, from the 15-minute to the 5-minute to the 1-minute. It definitely looks like that old school meme coin we used to trade. Oh, it was a scam and it's just gonna, well, no, it got some history behind this one. I'm still gonna wait on the trade here. So right here at the, you can do anything from here. Check out the YouTube, go find it, It still ain't none of your business. We're gonna do our thing. We're gonna take it nice and slow. I am gonna change the pace of the music and lock in. Maybe around lunchtime we're gonna be fully dedicated to the Degen lounge, and then from there probably mob around until close, Hopefully everybody be in profit. Including these guys over here, all micro trades in these accounts. I'll trade these one by one for transparency. This is my live journal. And remember, do your own research. This is not financial advice. This is how I do it. At the end of the day, you know what it is. It ain't your business. None of your business. 365 day. Scratch.
We good. This is the 1 minute. Yep, that was another zone that was created after this breakout of the 15-minute. No, I know how to count money. That's it. Oh yeah, that's why I don't put my trades on the screen, because it distracts people. I don't want people to see the money that I make and think, like, I want everybody to like understand any money is good in the beginning. So start small, get your strategy and understand what you're looking for, because the money gonna come. But that's why I don't trade on the screen, because I trade different accounts. I'm funded, so I have larger accounts with larger cushions.
Me and Angel trying to see the real tea.
Oh wow. Chanel, what you say? You and Angel trying to see the real tea?
We trying to see the real tea.
Angel see my trades. I post them on Facebook.
She don't know she be reading. What's the yen? Are you coming through? Oh yeah, I hear that. That's. Or you trying to get in that my time? You said that. Yeah, that's what me and Angel be doing. We go jogging every morning up the hills. And go get a smoothie. Yes, I'm. Whew. Trust me, I'm gonna be honest. I'm trying to learn. Okay. All right. We just came from getting a smoothie a couple hours ago. Getting a massage. My bad. Right. Exactly. That's why I'm trying to get to. Ain't nothing but time.
That's why I got Chanel starting. That's why I got Chanel starting with micros. People be underestimating micros. Your risk management. That's how I got so good. It's perfect teachings for people to understand. That way you work on holding your trades and not being nervous when you take trades.
I've been on YouTube too.
I thought you brought a course.
A lot going on.
That yellow line is the fourth TP. It prices getting exhausted when you start to. This is another tip, Chanel. When you start to see a lot of wicks like this, it just means the volume is low. So even though it's going to slow motion up here, I'm waiting for a better trade. I don't do all this wickiness.
Mhm. Mm.
Yeah, I mean it's definitely trending up, but it's just slow. Okay. All right. Well, I'm gonna come over to your page. Post it into your area somewhere under social media.
All right now.
Check, Mike. You got a runner. So yeah, that's not something I technically would chase. In 5 minutes, that might be my buy. 1 minute's telling me to get ready to buy this thing. So we see what's going on. I ain't dropped another line yet. I ain't talked to my favorite friend, aka Chat G-A-T. But I'm gonna do what it does, keeping it all the way funky. I ain't even changed the pace of the music yet. Let me get in touch with the rest of the bucks, see if we're gonna Degen it out and mob around. My trade might be setting up here. Got a couple of trades that might be setting up here. Definitely stays one direction. Let's see what's going on with this cattle trade. Yeehaw, motherfucker. With that being the first step down, I go over to back to 1 minute, right? And this breakout here, I think that's Do I trust it? Fuck no. Excuse my French, but no, I don't trust this shit. This ran me over again. And this is like standing on the opposite end of Marshawn Lynch. If they had the ball, they left too much room in the game, man. I understand it, man. I just can't get my, you know what it is. Again and again and again and again and again. I'll keep running in y'all face. Now I'm gonna take a payout, right? And then I'm gonna take 5 payouts from one time, right? I'm gonna be live doing it all. Again and again and again and again and again. This is me talking. You get a little bit more DJing out of me. But it's the healthy way to close. I'm gonna take my breaks. I'm gonna go to the gym. I'm gonna travel. We got a lot of stuff on the schedule. We got a couple of segments. If you are listening, I'm looking to go look at that line that's just respecting there. Let's see if it disrespects that line. But my next segment is coming up quickly and swiftly, and I'll be dropping it again and again and again and again. Let's see if we can make some noise off of that after the payouts item took. You know what I mean? I'm just saving this one. I gotta add to this payout that I took now. Cause I'm damn near flat fucking around with Top Step again. No, it wasn't even Top Step to you. Top Step, and I got a backstory on that. Top Step looked out. Top Step looked out. I've been trying to get in touch. Yes, they are doing upgrades and doing add-ons, but they definitely looked out, right? I ain't gonna worry about all that right now. I'm just keep running it back again and again and again and again and again. It didn't respect that line at all. Let's see how far it's gonna disrespect it. You know what I mean? We're gonna get 3 bars there and then turn around? Are we just gonna keep on? Because it ran all the way up. So I don't want to front run either way. Unless I see like another candle down and then a retest. You know. I'll get in with a whoa. First off, buddy, I was in my practice account. Always make sure you're doing what the hell you're doing. Wow. That could have just been really good or really fucking bad. I don't even know if they would have let me feel that. That was in Euro. But, you know, I got my hotkey set up. It was 20 contracts. That is not financial advice. Always check your order down. You know, order, you know, just where you're buying at. I forgot what they call this one. I don't have the dime up. I call it the dome. It's a nice brain piece. I ain't been using it lately because it doesn't make sense to use it here. It's on the New York market because it's just whipping around and you can't. I can't read it. I'll start using it in the Asian market. So I need to go ahead. That might have been it. Let's see if it respects that 70% down there, 80%. Because it sure didn't like that 19, 18, or yeah, pretty much. Where was we at? It turned around. Oh no, I didn't even go to 18. I mean, flat, you know, across the line. That would have been 181 specifically. I missed it looking up, not looking left. Ain't that about it? I'm not gonna chase nothing though. We got plenty of time. So I'm not tripping. I can't wait. I'm about to get back to traveling a little bit. I'm gonna go hit all them places. Go see what traveling buddies I had out there, got out there. See what trading buddies I got out there, you know. If you're in the Discord, you know we talked about it. I'm still waiting for all you guys. We're gonna post pictures of a tie. Everybody's going to get a tie. The backstory there, but everybody in the Discord is going to get a tie. Yeah. I respected the. So that was your entry here, right? Let me go back. Now I'm getting with the market. We just talk through like we talking through the people who set them trades up. I get to doing it by myself. I always wonder it somehow. Skip a step. if I moved this up 2-1, right? I would have been okay. I still would have been okay. Ish. One thing is, you know, do I really want to play that right there? Or do I want to get in? I want to get in somewhere near my stop loss. This is a 15-minute also, so I could just be all around fuck up. So it wasn't time yet. Yeah, it wasn't time yet. I be rushing because, you know, I'm American. It's goofy. We're gonna keep this Degen, you know, I'm gonna try to keep it Degen. Definitely not for profit. It's not financial advice, and you must do your own research. Grown folks on, ain't no tears in trading. If you ain't careful, you lose a whole bunch of money. You might break some stuff. I ain't never been there before. Alright. Well, I'm gonna go ahead and pick up these drumsticks because I'm gonna wait for this to feel me here down here. I'll even I'm coming through this the way it's moving. I don't trust it all the way. It's gonna stop me, so I'm gonna drop a line here just to see if was a fifth. And that's not even nowhere close to the bottom of the 5-minute range. What the 15-minute looking like? Yeah. I'd rather see it extend out a little bit more. I'm looking for a pullback. That wasn't heavy enough for me. Even though it's pushing through on the 1 minute. It's a nice heavy push on the 1 minute. Now I'm gonna sit back and watch it. Talk you through it, but it'd be super risky. There's a lot of risk there. If you were trying to hold it any longer than 1 minute, you know. I still ain't changed the music up, huh? Here we go. Alright, y'all. I'm here. You know what it is. There go my retest. I want to see it come down close to the bottom of this range. A bigger time frame, my 5 minute, you know. Let me see, my 5 minute, where do I want it line out at? At least, boom. Right. Change the color of this. And I'll wait for it to come to me. If it don't come to me, I just don't take the position. Because it don't make no sense for me to chase it here and I missed it already. Right? I don't know where I was at. I just didn't trust it in the 5 minutes. That's what happened. I need to see something heavier. I want to see something a little bit heavier. This can come get all this right here and down into here. And I'll be sitting here looking like Gang Goofy. So no, I don't like that. Alright. I'll even give it a shot to here. Above and below 7,000. That was the test of that zone again. I mean, so, alright. What I'm usually looking for, this is definitely what I'm looking for. Ha! Ha ha! Ha! Wait. Blue chip keep hitting with it. You guys are catching me here. Shout out to Mr. Blue Chip for this meme. What the hell? Don't want this shit happen to you traders. Don't be this degen. Don't be this degen at all. That shit happens. Don't be that degen. Alright, I got time because of the fact of the way I see it, right? This is broken out. It went to break out here. It slowed down and then said, nope, I'm breaking out. Now retested it. I'm looking for it to come down and verify for me one time. Clear this cash pocket here. And then continue to the upside. This is my verification. I want to see some cash here. I'll even take the entry here because if I move that up, I'm still in my 2 to 1. But I need to see this range play out because this is a big range here for the trade that I am trying to trade. And this ain't everybody's trade. And this ain't even none of your business. But with this range setting up right here, right? This Dorito pattern I see just with the form of my eye across this here. I know it's going up. But like I say, I know it's going up all day. And as soon as I say that, put my trade in. I waited, 3 candles now. I want to see a retest. And then I want to see a push higher into this next leg here. And if I feel like it, I'll hold it. But if I feel like I seen enough profit for the day, I'm going to take it. And ain't going to retest. We got 3 minutes in that 5-minute candle. What we looking like over here? Wavy, baby. How many times they come over here and touch? Came down once. You know, I'm looking for it twice. I'm looking for it here. I'm looking for it here or here. 7 foot above, below. That's what I'm looking for. I'm gonna wait. Sitting on my hands. It broke out of there when I was doing something else. That's a beautiful breakout. I just didn't see it. Came to where I wanted it to. I was late behind it though, so I wanted it to come back to where I wanted it to. Oh! I ain't gonna do all that. That motherfucker is running. Right turn. Look at that. That's beautiful. So I know my execution has to be spot on. If I want the trades that I want, 2 to 1 each time. You know what I mean? But the trade is definitely there. I'm glad that I see it more and more each and every day. Each and every way I test it, you know. It's a beautiful little breakout there. Look at that. None of which that I caught, but I'm glad I'm catching the my setup. Just verifying my setup. I missed it, but it's there. It still didn't. Okay, so what I understand for the Bollinger Bands also, right? If it's running, it's not going to come back down to the other side of this range. It's not supposed to. It's in the uptrend. My bad. When you sitting here just talking about it, I should have bought it and sold it already. You know, with the confluence of one of my other hobbies. It's just not, you know, buy, sell. Buy, sell. As soon as it touches this line, buy that motherfucker, huh? That's just what I'm seeing right now. If that's what I'm seeing right now, that's what it is. So come up, bump, but it's never gonna. I can't say never. Cause this is the top of the range. I don't want to fade the extremes. Cause right here you can just say, hey, bye bye, and go all the way to my 2-1. So what I'm gonna do again is I'm just gonna sit on my hands because I keep missing it. That's the 1 minute time frame. I'm not missing it. The play was there. My execution wasn't there. I was here the whole time. You know, no position is better than a shitty execution, a loss of profit. But honestly, anywhere I would have grabbed this at, anywhere. I would say after that original breakout so far, you just held what candles is 910. I don't know how this whip was. I better verify, right? Yeah, man, you're alright. Just hold. So, alright. But no position is better than get faulted out. And this is from what time to what time? I use these rules, you see. So at the bottom of the screen, and you just break. There's a lot going on there, but if you break it down Barney style, you know, one step at a time, you'll see it every time. All right, I'm gonna put on some education for a little bit, because I'm about to start trading, you know what I mean? This is what I do. This is how I do it. This is how I'm about to influence, you know? The biggest contradiction is it ain't none of your business. Alright. We real Degen, we real live, we real transparent. Big boy, big girl pants on. Same for the faint hearted. If you know, you know. I was hawking this. Good back test. Good live test. I was hawking this. I'm not gonna be discouraged because it's there. It was the breakout. Right? Retest, and here we go. It's alright, y'all. We're getting closer and closer. Look at that. They just gonna wait until I get all 5 of them copy trading, right? That's what they gonna wait on for me to tear them up. For me to get it exactly right down here. With a limit order out golfing somewhere. That's what's gonna happen. I'm gonna hear an order fill come across my phone, and I'm gonna sell it. Sell it out. No, I'm playing. I'm gonna lock myself out. But yeah, we're coming across that round number, but it's looking like it got some squeeze. It got the juice. That's from the 1 hour. So we're back down to the 30-minute, right? 30-minute looking like it got the juice too. Like ain't nothing but the upside. If it ain't. We about to now see what's really going on with it. I mean, shit, we've been knowing what's going on with it. Buy it. Buy the dip. You gotta find out where the dip at. So we're gonna go to the 5-minute. I can't see no dip there. Okay. That's how you trade that. So we want this to break out. And pause at the structure here, right? It's either gonna break out from here, 5-minute, right? So we're gonna come collect some more money. Same program, different day, right? Same program, different trade, rather I say. You know what I mean? I'm gonna just keep it all the way funky with you, man. I ain't got sick of having you. Hey, how are you? It gives me the space, just trade. That's why I chose trade. I get to breathe. I get to be more myself. Since being able to do that, it's been a lot of weight off my shoulders, off my life, off of everything, honestly. So that's what the Degen is all about: being healthy, doing what you do while you're doing it. I would say number one rule for me is proper preservation of capital. Let me say it again. It's the proper preservation of capital in this game. And to make sure when you do take those payouts, you're spending them in the right places. If you're gonna not take your taxes, as soon as you get your payout, put them up away somewhere. Put them somewhere where it's getting some APY sometimes, you know. Take the APY money and spend that. Or from there, you know, you can trade, you know, a portion of that to options, other things. You know, there's a course for that somewhere, I'm sure. Or somewhere free out there on the web. Or different tools out there you can get it, I'm sure. I'm sure you can. I believe in you. We're gonna test out this range right now. I mean, you don't know. You want to slow down or go to me. My dog just really doesn't like the neighbors. I don't know. You can't get to him. And if he does get to him, he's just gonna wag his tail. But yeah. And this is why I don't necessarily want to trade the NQ. I need to probably, go over to the ES, build me a backup. I psychology now. I should be in the mini, right? I should be in the mini throwing 3 lots of the mini. And someone would still say that's not sizing down. I would have sold it and I would have got rid of it right then. Woulda, coulda, look at that. And I didn't have no holding power if I got rid of it right then. So that was a breakdown, quickly break. But then, was it really a breakdown? Do I buy it at the bottom of this range? It's like, dude. Oh yeah, I forget. It's right here on the field. So just wait. If it doesn't just blast through, I'll probably buy it. Didn't even want to touch that long, huh? So it looked like I'm getting closer to do something else. Just don't know what, I mean, hey, guess the hell we do know what's going on here. Sir. What's going on here, sir? What do you see, sir? I see that I should be not trading this. If I don't want to get whippy. It's not even, I mean, fuck. It's a trend day. What am I doing? Getting ready to buy it. I'll buy one. I'll buy one.
Order filled.
Ooh-wee. Bought it at the wrong spot. Moved my stop loss. Look at that. Ooh wee.
Order filled.
Bought it at the wrong spot. 287 down. Ain't that something? I got it all here. Right? Oh crap. What did I just press there? I got impatient. Glad that's nowhere else but here. Alrighty, I wanted to buy it. If it didn't blouse through there and hold through there, right? That was my buy there. Didn't blast through there and hold. You buy the bottom of that candle, you buy the next candle. You Russian. What news?
Top, right? Tested it once, twice. And as soon as we started the breakdown, I started building that position. 1, 2, 3, 4, and then 5. And it was right around the time Hogue asked, hey, are you still short? And I was like, no, I closed out those ones from earlier, and then we popped back up here, consolidated, and now I'm looking for this market, looking for a deeper pullback. I know it's hard. I'm going against the tip of the week. The trend is your friend, but I mean, there's.
I have great timing, don't I, Dakota?
What's that?
I have great timing, don't I?
You do, Hogue.
Oh, Hogue,
I don't
check your
mind
401k.
I
Hogue, hit us with check your 401k.
You grabbed it.
But that was a blunder.
So we'll see. We'll see if we can get some momentum to the downside. I'd like these 115s now. Looking for just some other test of support. 114s. Like I said, 19,000 still in play. That big round number. If we can get some selling momentum right back down, if we break through these 151s, might close out another one. But loving these lower highs and lower lows.
It's okay.
40.
Just a reminder here: London closed in 5 minutes.
What was that, MP? What happened? Did you miss a trade?
I just wanted to be, when he said he was getting short, and then Jack said I'm short, we were right around our highs, and I'm like, this could be a good short. Hint, woulda, coulda, shoulda.
Yeah,
I'd rather would have had no
It's
position.
nice to see you guys. That's why it's great trading with other people. Nice to see you guys taking advantage of it.
Yeah. Jack, what price are we short from in the micro ES?
Well, for short 4 from 54.77, we took one off at 1-to-1. We're just risking $150 on it.
Okay. Stuff. Got some shorts in the house. Tilt 50-50 right now.
I'm about fully scaled out of my options position. I have 5 runners left. I'm up 9,200 on options today.
Life's good, man.
Good for you.
Life's good. Might have a 50K week here.
Baron. Check him out on his Discord.
Better than AT&T.
Vader AT&T.
Way better than AT&T.
Hey, what if we could allow you to take a payout and go directly to your options account? That'd be cool. Something you do.
There we go.
Well, I mean, it goes to your personal bank, and then it goes there, right?
Yeah. So it goes typically the way I do payouts is it goes to the bank. Immediately take 30% of that and
Why just try to buy that bounce?
set it aside for taxes. And then anything else, I'll cut some up into savings. I'll cut some up into other investments, just like general index funds, and then leave a little bit, 10 to 20%, dump it into.
There you go.
Okay.
Look at you
KT.
diversifying your stack.
Your stack.
I mean, I'm unemployed for the day. You gotta have something.
Then you gotta
I don't.
cuff a couple Benjamins and take your girl out to another concert.
There you go.
Came out so smooth.
There you go.
Came out incredibly smooth.
That was not.
Very smooth.
I love this, my guy right there. MP
MP
in the house. What did they see? And someone in the chat said, "Where else?" Yes, where else do you get this? The insight we get from the founder daily is amazing. I rock with Top Step. Word, Alvin from BK, out to Brooklyn. Let's get back to Dakota's trade here. Dakota, we are now trading 140s at 138's print. You are short from 195. 5.
Yes, sir.
many
Yes,
times?
sir. The seller's starting to come in now. Seller's starting to come in. Paper
Get
kit,
back
paper
down.
cuts
Oh,
on the way
guys.
up. Make some money on the way down.
90
Yes.
seconds. London close.
We're short 3.
Nice. Aaron, you had your eye on those 200s in the Nasdaq.
I did. There's some. So I've been using Edgeful a lot. Actually,
Got a stat for us?
Yeah, I do have a stat. So the 0.2 on breakout days, the 0.2 extension of the initial balance, that has around an 80% chance of hitting, which that's that green line on my chart there, that first green line. We hit that and then rejected off it.
Okay.
The 0.4 extension, that's that, that's that 0.3. The 0.3 is that second green line that has a 70% chance of hitting. 0.4 is 68% chance of hitting. So, if I'm going for the 0.3, I might as well go for the 0.4. It's only a 2% difference in the stat.
Yeah.
I had a meeting with their CEO to become an affiliate, and he showed me some stuff on the platform that I wasn't using. So started using that, incorporating it, and it's crazy what it can do for your risk to reward when you know those.
What stat or just Edgeful is the stuff that you're finding on there? I mean, they're just taking stats and
Yeah.
making them.
They're visualizing them. So my day job was actually, I was a data analyst, so I was doing a lot of data visualization. So this just like it connects really well for me. But I've been using the initial balance for about 1.5 years now. So just adding to that toolkit where it's just additional stats to look for extensions off the initial balance, you can just squeeze more profit out of it and up your risk to reward based off those stats.
I just closed off another one right here in these 130s. So I'm still short 3 for 195.
Yeah, we took one off at 2-1 there, so we're short
Nice.
2 MES.
Nice.
Where's your target, Dakota?
So for the next
That would be
contracts
me
would be
fading the
lower
exchange
100,
trying
kind
to
of where we
chase
found
it.
support
I'm gonna
before.
wait till it
Almost
comes
where you got
down.
long, Baron.
I would target. I would have final target at the 70s. I'd probably front run.
070.
You're talking about 070s, right?
Yeah, 19070.
Man, I
My
can't.
final
Good
target
stuff.
is going to be 19,000, maybe picking just a little bit below that. So
That's
Ooh,
pretty
runner.
my mini allows me to scale out and then keep a runner.
Yeah.
And if this market does want to just gain
Amen.
momentum to
5
downside,
minis.
I want to take advantage of it. I took the risk going up.
That's
I
cool.
took paper cuts going up, so I get into a good position. I want to take max advantage if possible.
Yeah, I'm gonna step away right now.
Yeah, I
I'm
went to
getting
break even
too
on the
locked in.
last 2. And
I'm
we
here
will
though.
just let 'em
You
cook.
know,
It's
that was a heavy trade.
Nice.
I didn't
Trading
have my
fellas.
wrist set up. Got my wrist set
couple
up
pro
now.
ballers, couple big
I
orders.
just slid it off
Talking
the way.
trades, talking strategy, talking price targets, talking stops. You don't get this anywhere else.
It's first day in
awesome
this
stuff,
one,
guys.
so that's not bad off of what this is.
19,140 last
Hey,
trade in the Nasdaq.
that's a trade and
Jack,
a
we've
half.
got
So that's what I call
how many
it.
left now? I'm sorry.
2.
2. Thank you,
2
sir.
and the stops at break
And I'm
even.
gonna-
I think
I'm
we'll
gonna
see.
just
I
take my
may
time
trail
here.
it. If we're lucky enough for this to run the rest of the day, we'll just trail it on the 15-minute chart. Hey, MP, we've been playing a new game
Oh yeah.
called Who's This Effing Guy? We got another one. Basically, I'm just going to show a picture. You tell me who this effing guy is. Who is this effing
Bless
guy?
you. Oh, I know that
In the
guy.
business.
I can give clues.
From the
Let's go,
Yeah,
Chad.
take
Who is this guy?
It's G.
Scientology?
Last name starts with G. I forgot. I can't pronounce his last name.
He
Starts with
has
G.
allegedly some very interesting contents of his desk.
Order
Yeah.
filled.
Who's this effing guy?
Who is this
Gunlock?
effing guy?
Order
I was
filled.
I
Good,
can't
good.
get
Go to hit it.
killed.
Ding ding. This is
What is
Jeffrey Gunlock.
There it
What
is.
does
That's
it
how you
mean?
pronounce it.
On
Chat.
Unlock.
Jesus.
Yeah. You show the other one, Jack.
Yeah.
See if MP knows the
It
one
just
before.
went
the
down there,
diff.
touched it, and it's gonna run back up.
Oh,
Gotta
yeah.
hit
You
it.
want to toss up the
There's 2
first one real
trades.
quick?
I'm done with
Speed
it.
round.
That's 500.
Who's this effing
for
guy?
I
the
love
day.
his name. Who's this effing guy? Who's this effing guy?
Two bit we gotta go around. This effing guy.
Hey,
That one.
Chicago.
That's fucking.
Oh, this
wild.
is
Wow, always trade what
Is
you
this
doing,
deal?
man.
No, this is not deal. This is
Wow, I
no.
could have got out of that.
He's a
That's still going in the wrong
Yep.
direction.
Yep.
investor.
Yeah.
The
Touch
DJ.
the bottom of the
It's a
range.
DJ as well.
Oh, Solomon. Whatever.
Yep.
right?
That's what did it. All you gotta say is DJ.
Yeah. I mean, these Goldman Sachs.
Yep.
Yeah,
Who's
right?
this effing guy?
Thanks for
When I
playing.
heard he was doing DJ, when he was DJing in the Hamptons, I was like, that is
Hamptons.
cool. That is the future of executives, and they got to be cool like that because it's just cool.
I agree.
DJ
Goldman
in the
Sachs
house.
right now is lobbying their shareholders for $160
I just ran
million
into a brick wall with that
payout
one.
to
I'm not gonna lie to you.
Mr. DJ Solomon.
I just
and
said
his
I was
number
walking
2.
away,
Good money if you can get it, man.
and I faded my own play.
Good money if
Wow.
you can get it, indeed.
Oh, we got about 21 minutes left
Beautiful.
here on Fast
Yes,
Markets.
beautiful.
Let's take a look at some other live funded trading P&Ls here.
That's the
This is
set.
about as of 34 minutes ago. Ronald putting up 21 large today. We got Ben T up 18, Charles G up 15.
All right, yeah, I'm stepping away.
Some red out there.
How the fuck do you do that?
Code up 7 large,
Dude.
probably more now.
Dude.
But yeah, seeing some green out there. I also seen some red as well. A little more green than red today. So David Green up $255, up about $500 yesterday, newly funded. Also, David Green saying this is one of the most, if not the most difficult trading environment he has ever seen in his 45-year career. So keep that in mind when we're taking these trades. Risk management.
Risk management is key. David Green's one of the best at doing that as well. Trading size, trading
He's a good guy.
small, and following a process.
He's an OKT, top step.
Like when did we come? OKT. This is recent.
This
OKT,
is
don't-
I did. We was in a meeting yesterday, because
I was gonna say this is
we're
fresh.
we're really moving towards away from just an affiliate, just a person that pumps a code, to homegrown. Came from Top Step. Here they are. Here's Baron, number 30. He's working for number 15. The highest he's ever got was 22. Blah blah blah, whatever it was. And then Baron goes away. Then Baron comes back, and then now he's there and he's staying there. And like, and how he talks about trading is the traders that we want to be around. You have to be around these type of people, or else you're gonna get.
So what I'm about to do is real deal. I still ain't changed my motherfucking play. This ain't got nothing to do with nothing. So I'm resetting right now. So what's gonna happen is I'm gonna press pause on YouTube, and I'm gonna reset the YouTube. This next video gets stopped out because of music copyright, so be it. At least we got the content before. All Degen, I'm not giving a fuck. You know, this is not for profit. Do your own research. This is not financial advice. Keep it Degen, y'all. Pause on this YouTube here.
And then you got other people saying, well, no,
We'll be
it's
right back.
20% off, and it's here's my code. There's like a